Old Republic International's Q2 2026 print is officially out. Operating EPS came in at 76 cents, which is down 9.3% year over year from 83 cents.
Yeah, but consolidated net premiums and fees earned actually hit $2.1 billion, so that's up 5.2%.
Right, and the consolidated combined ratio ticked up as well, landing at 95.3%, up from 93.6% last year.
Exactly.
So for you listening, this is the core tension we're digging into today. How exactly does a company grow its top-line revenue by over $100 million in a single quarter, yet somehow see its operating earnings per share contract by 9%?
I mean, it's a huge divergence. And to understand it, you really have to look under the hood at the two very different engines powering this company.
Which are going in completely opposite directions.
Right, totally opposite. You have the specialty insurance segment, which is their massive revenue driver, and that experienced some really severe margin compression this quarter. But then on the flip side, you have the title insurance segment staging this like absolutely massive rebound.
Well, let's pull those two stories apart, starting with that margin compression and specialty, because to explain the overall EPS drop, we have to look at the biggest moneymaker.
Yeah, let's look at the raw segment details. So premiums earned actually grew 2.3% to $1.32 billion.
So the business is still coming in the door.
Exactly, they're growing market share. But the pre-tax operating income just fell off a cliff, down 21.7% to $198.6 million.
Wow. Dropping 21% on rising revenues, that's going to trigger alarm bells for pretty much any investor.
Oh, absolutely. And we see the combined ratio deteriorating there to 95.5%, up from 90.7, which, for anyone newer to this, anything under 100 is technically profitable, but moving almost 5 points in the wrong direction is, well, it demands some serious scrutiny.
So what's the actual culprit here?
Well, there are two main culprits, really. First, you have this $40 million unfavorable prior year reserve development.
Okay, wait, because management explicitly said they had favorable development in their auto and property lines. So where is this $40 million hole actually coming from?
Right, so it originated from a runoff transactional risk business. It's sitting within their financial indemnity line.
So it's basically a ghost from balance sheets past.
Pretty much. I mean, they aren't actively selling new policies in this niche anymore. The storefront is closed. But they're still legally on the hook for claims from these long-tail policies they wrote years ago.
Oh, so an old claim pops up or inflates because of litigation, and suddenly the reserve pool they set aside just isn't big enough.
Exactly. So they had to shore those reserves up by $40 million.
Right.
And even though current lines performed well and offset it a bit, it was still a massive drag.
Right.
But that reserve issue is only half the story. The second culprit is a completely bloated expense ratio within the specialty segment.
Yeah, I want to unpack this expense ratio jump because looking at what they're spending money on right now, it's like they're renovating a massive restaurant while it's still serving dinner.
That's a really good analogy.
Like revenues are flowing, the dining room is totally packed, but the scaffolding is just eating all your profits.
Right, you're paying contractors double time to work quietly in the back.
Exactly. And buying brand new ovens while the old ones are still plugged in. Because they are standing up 7 new startup operating companies simultaneously.
Yeah, inland marine, cyber, environmental, all these niches.
Plus, they're pouring huge capital into IT modernization, AI, data analytics. So my question to you is this aggressive spending spree a structural red flag or just a temporary growing pain for a 100-year-old company?
I really look at the strategic necessity of these expenses. It points heavily toward a temporary, albeit pretty painful, growing phase.
Really? How so?
Think about the IT modernization. When a legacy company upgrades its core systems, there's just this unavoidable transitional squeeze.
Right.
The cost for the new cloud infrastructure, the AI tools, those start amortizing on the income statement immediately.
The bill comes due the moment you sign the contract.
Exactly. But you can't just flip a switch and turn off the old legacy mainframes overnight. You have to run both systems in parallel to make sure underwriting doesn't miss a beat. So temporarily, you're eating double expenses.
Ah, okay. That makes sense. They have to maintain target combined ratios of 90 to 95% over the long haul, which means this tech is basically mandatory.
Yeah, you just can't underwrite complex modern risks like cyber liability in 2026 using databases built in 2010. You need the analytics, or adverse selection will destroy your margins.
And those 7 startup companies need heavy upfront personnel costs, too.
Oh, massive. You're hiring specialized executive teams and underwriters long before a single dollar of premium is ever written. They're basically taking the financial hit on the chin today to build tomorrow's revenue foundation.
Which makes the other side of the business so incredibly crucial right now, because as specialty dragged the bottom line down, Old Republic still managed to pull in $186 million in net operating income.
Yeah, the title insurance segment completely pulled its weight.
Oh,
I mean, the numbers here are honestly wild. Title revenues jumped 10.7% to $772.6 million.
and the pre-tax operating income?
Skyrocketed 130.5% to $55.9 million.
That is insane.
It's a remarkable turnaround. The
Like,
combined ratio improved from 99.0% down to 95.1%.
okay, wait, here's where it gets really interesting, and I have to push back a bit. Because everyone listening knows the real estate market is incredibly sluggish right now.
Oh, completely.
Right. Mortgage rates have paralyzed housing turnover. Nobody is selling if they're locked into a sub 3% mortgage. So how on earth is a title insurance segment posting 130% income growth when the housing market is basically frozen?
It's a fair question. The most common assumption is that they're just gouging on price to make up for lack of volume.
Right, that was my instinct.
But the reality is entirely structural. It comes down to their variable cost structure. Unlike competitors who carry massive fixed overhead like physical branches with salaried employees, 78% of Old Republic's title premium comes from independent agents.
Oh, so they're paid on commission. They only eat what they kill.
Exactly. So when the real estate market drops, Old Republic's acquisition costs drop in perfect tandem. They aren't paying idle agents sitting in empty offices. The expenses scale down proportionally with the revenue, which heavily protects their downside.
Okay, so when the market freezes, their costs freeze with it. That protects the baseline margin, sure, but it doesn't fully explain a 130% explosion in income.
Right, you need two more factors to explain that jump. First, you have to look at a highly favorable comparable from last year. In Q2 2025, their earnings were artificially suppressed by a $15 million litigation settlement.
Ah, so the hurdle to beat this year was just artificially lowered.
Yeah, that one-time legal penalty alone added 2.1 points to their expense ratio last year. So when you remove that $15 million anchor, any normalized growth looks incredibly explosive on a percentage basis.
Got it. And the second factor?
Where they're actually finding the business. Residential real estate has been sluggish, yes, but Old Republic successfully leaned heavily into the commercial real estate market.
Which are much bigger policies.
Massive. Commercial premiums now represent 25.4% of their total premium mix, up from 23% last year.
Hunting bigger commercial elephants offsets the lack of residential game. That's a brilliant pivot. So shifting focus a bit, we really need to examine how management is deploying all this cash, because they are generating significant liquidity.
Yeah, the capital allocation really highlights their century of experience. They returned $137.4 million to shareholders just in Q2.
So that's $76.6 million in regular dividends and $60.7 million in repurchases.
Exactly. And their book value per share now sits at $25.33, which is up 7.2% since year-end 2025.
Inclusive of dividends.
Right. And their net investment income rose 6.1% to $182 million.
Which comes from a really conservative $17.1 billion portfolio. I mean, it's 84% fixed income or short-term, 99% investment grade, and zero exposure to real estate, hedge funds, or PE.
It's the absolute bedrock of their financial strategy.
But, okay, here is where I see a potential contradiction. They have this boring portfolio, but look at their corporate actions. They're buying back stock, they've hiked the dividend for 45 consecutive years, funding AI, funding 7 startups. They just closed the Everett Cash Mutual acquisition, and they just issued $700 million in new debt.
It sounds like a lot when you list it all out.
Right. Are they spreading their capital too thin? From the outside, it looks like they're leveraging up the balance sheet to fund this aggressive expansion without cutting the dividend.
To the untrained eye, yes, it looks dangerously stretched. But it's actually a masterclass in risk management. Take that $700 million debt issuance. It wasn't an opportunistic leverage grab. It was entirely prudent pre-funding.
Pre-funding for what?
They have a $550 million note maturing this August. So they went to the market in May to secure the cash ahead of time, locking in liquidity and rates, rather than leaving a $500 million refinancing to the very last minute.
Oh, okay. So they're just replacing old maturing debt with new debt.
Exactly. Not piling massive new leverage on for the sake of growth. Plus, we have to talk about what management calls their low volatility model.
Break that down for me. How does that actually work in practice?
So they engineer the business to avoid massive swings, They use reinsurance heavily, and more interestingly, risk-sharing structures, like captive insurance programs.
Right. How does a captive limit their volatility?
Think of a captive like a massive corporate deductible. If a logistics company wants to insure its fleet, Old Republic helped set up a structure where the client retains a huge portion of their own risk. Like they're responsible for the first $10 million of losses.
So the client has real skin in the game.
Yes. Old Republic's risk is strictly contained to the upper layers of liability. It ensures their capital isn't wiped out by a single bad storm or a string of localized lawsuits.
Which explains the boring investment portfolio, too. They don't need to chase high yields and speculative assets because the underwriting itself generates reliable, low volatility cash.
Exactly. Predictable cash flow is the only way you can confidently raise a dividend for 45 straight years. And it gives them the dry powder for accretive acquisitions, like the Everett Cash Mutual deal, without scrambling for financing.
And that deal is expected to bring a $125 million gain, right?
Yep, immediately accretive to earnings.
It's the financial equivalent of the tortoise beating the hare. But this tortoise has $17 billion in its shell. Which actually brings me to a final thought I want to leave you, the listener, to mull over.
Yes, that.
We spent this entire deep dive looking at a company whose historical selling point has been boring, low volatility consistency.
Hey, steady book value growth.
But look at what they are actively doing today. Standing up 7 specialty startups, pouring capital into AI, and massive IT modernization overhauls. They are aggressively renovating the restaurant.
It's a big shift in behavior.
It is. So the question you have to watch closely over the next few quarters is this. Does this aggressive modernization inject uncharacteristic volatility into their historically smooth growth? Can a century-old giant embrace the bleeding edge of AI without breaking the conservative machinery that got them here?
That tension between preserving the past and building the future is definitely the defining narrative right now.
Exactly. So keep a close eye on that specialty insurance expense ratio as we move into Q3 and Q4. And if you want to keep tracking the underlying mechanics of stories like this, make sure you follow the show for our daily earnings coverage. Thanks for joining us as we unpack the scaffolding today, and we'll see you on the next deep dive.